Last week, we talked about NFTs and its growing importance in our lives. And this week, we'll talk about DeFi infrastructure and its primitives. This is the agenda of today. We'll talk about what is decentralized finance, and we'll talk about its advantages over centralized finance. And we'll go through two important DeFi tools. One of them is decentralized exchanges and also decentralized lending. And there will be some discussion around these topics. DeFi compared to CeFi has a bunch of advantages. So if we summarize DeFi and CeFi, decentralized finance is when there is a transaction between two object, people necessarily, or person and object, doesn't matter. There are a bunch of intermediaries, right? Like a bank, person, and the disruption in finance came with decentralized finance, which this middleman now is replaced by the blockchain and smart contract protocol. Rather than just giving the cash to a bunch of investments managers or bankers, people prefer to use DeFi to invest, to borrow and lend using cryptocurrencies through the benefits of smart contracts. As you can see, like for instance, when there is a central server before, it's like a bank has its own servers, transactions are recorded certain servers. So it can easily be hacked. And compared to centralized mechanism, decentralized mechanism has a bunch of servers actually. So that's why we call it a decentralized net, right? It's called mainnet. And all the transactions happen and validated at the same time through this network. We talked like 2 weeks ago, the several different layer 1 protocols, basically through their layer 2 protocols and different dApps, they make that transaction go through their web. And everything on DeFi is basically done through the blockchain. So the blockchain is basically a incorruptible ledger. It's a distributed ledger like this one that keeps the record of every single transaction. We'll talk about different DeFi terms here, and those terms are mostly summarized in this big picture. And as we mentioned, when a peer-to-peer transaction happens, it goes through a centralized web, right? And there are different protocols and mechanisms that are now inside the DeFi markets, right? So we learned what an oracle is. And in DeFi markets, oracle's task is mostly to provide the prices of cryptocurrencies, right? It looks at different markets and it aggregates, basically it gets data from different DEX or centralized exchanges, and it takes a bunch of data and eventually takes an average, gets rid of the outliers, and then it provides that data to the app that's asking for that data. Right. We'll talk about some of these terms in the next slides. Most important term is liquidity pool. So liquidity pool compared to centralized finance might be not necessarily a new term, but the way that it is deployed is partially different, right? Because in the past, when you invest your money to a bank, let's say you are keeping your $100,000 in the bank, and bank actually use that money to provide credit to someone else, right? Basically, you are placing your money, and then that money that you are earning 1% or 2% or 5% interest is going to another person, and they are probably getting much more money from that person, right? That's how banks make money. So they get your money and they invest to another place, and they basically do an arbitrage, right? Buying it for cheap and selling it for more expensive. The same pool, basically, bank has that pool. All the money deposited into the bank is their liquidity pool. Basically, that's the amount, that's the funds they can play with. So the same logic is actually in the decentralized finance. There's a pool, everybody throws their cryptocurrency in it, and as you can see, the funds are thrown together in a big digital pile, and the decentralized exchange decide what other users can do with this big digital pile. So, and if we compare the DEX and centralized exchange and decentralized exchange, they have their differences, but it has also a similar mindset, but just implemented differently. So if we compare to centralized and decentralized exchanges, well, in the centralized exchange, of course, there is a middleman, this centralized, right? They make the decisions. But in the decentralized, it is mostly person to person or person to object. It's totally through peers. The KYC is standing for verification, identity verification. So in a CEX, centralized exchange, such as Coinbase, Binance, right? You are regulatory wise required to put your ID down so that in case of a fraud or in case of an illegal action or even in case of a hack, they know who they are dealing with, right? So maybe you transferred 100 Bitcoin to Ukraine, right? So basically they gotta know who you are at some point. And that is the biggest disadvantage of CX because people want privacy, right, at some points. But in most DX, decentralized exchanges, that's not needed. And security-wise, because there is still a database at the backend, right, like for Binance and Coinbase, it can be hacked, so it's more fragile. It's really hard to hack a decentralized exchange. Convenience-wise, you can simply go to Binance and Coinbase and get an account. A decentralized X or any blockchain company has problems adapting to new users, right? Because it's a new environment and there are interfaces between fiat money, between dollars and euros. Like, how will you really connect to crypto, right? So, and there are wallets for those, like MetaMask, Trust Wallet, and so on. So, and a blockchain company promotes you to use their tokens, right? A utility token, or, maybe you should do some transaction with Ethereum. So eventually you should connect to your MetaMask or your other kind of wallets through the web, like we call it Web3 wallet. So, and not everybody, like especially after 40-50 years, people, they are not really used to it. I think that's the biggest problem with the decentralized exchanges. And private keys, basically centralized exchange, Binance, Coinbase, they own your keys, right? I mean, they have your key. But decentralized exchange, you have to keep your private keys. Like, you have to, just like you don't lose your wallets, you shouldn't lose your keys and passwords for decentralized wallet. And the tokens, basically Binance, Coinbase, there is a pool of tokens that you can make the transaction. Like, let's say I came with Memo token or Özü token tomorrow. They won't list it, but I probably will find some decentralized exchange to list it easily, right? At some point. Yeah, we have a friend here. He got a link. He clicked on the link, right? And they got into his MetaMask and stole their 3 avalanche, right? Something like that. Yeah, so there are a bunch of crypto hackers basically going into Discord, right? Telegram, and they are just saying, hello, kindly, can I help you with your problem? And they send you a link, you click to the link, and your basically entire funds are swapped in like seconds. And you open your MetaMask, where's my Ethereum that I collected in years? So just watch out all those scams. They will be much more, okay? Like, there are tricky words like kindly, hello, sir, yeah, and bunch of tricky words that your AI in the background should suddenly trigger. Okay, so this is basically the summary of DeFi differences, like between a decentralized exchange and centralized exchange. So a decentralized exchange is private, much more private. You have the control. It is more secure because it's on blockchain. It's very hard to get hacked unless there is a flaw in the smart contract. There are a bunch of restrictions in the centralized exchange, right? The Coinbase a month ago, they just sent me a new basically exceptions regulation. They are saying except, otherwise I cannot get into my account, right? So the government is always on top of centralized exchanges. The liquidity is one important component of exchanging. We don't necessarily expect a decentralized exchange have liquidity centralized exchange. When you look at Binance, Coinbase, easier to use, and people think it might be even safer, which is not necessarily, but because it's more easy to use, it can get more customers. That's why it might be faster to do a transaction in a centralized exchange compared to a decentralized exchange. So Tolga is asking how governments can have control over decentralized exchanges. Easy to have a control over centralized exchange because they cannot run away, right? They cannot basically, they have to obey the regulations at some point. But just the name says decentralized exchanges is owned by people using it at some point, or can they just unplug it? Can somebody unplug Uniswap? They can't, right? It's on blockchain, Ethereum. So Ethereum can't be offline, but it's not proof of work anymore. It's proof of stake. I mean, going proof of stake, right? It is still computer nodes in terms of, but there are people running software behind. So it will be a little tricky. Yeah, okay. Well, that's the answer, I guess. But regulation-wise, I don't think they can regulate any of them because they should regulate Ethereum, right? So, and if they cannot regulate the king, they cannot regulate the slave. Well, but the contract is deployed on Ethereum. They should unplug Ethereum. They should cut Ethereum out of the game, right? I mean, they cannot just go and take the Uniswap portion of it. Also, complexity-wise, I think the one reason DEX, decentralized exchanges, are not really adopted compared to centralized exchanges. Somebody can easily go Binance or Coinbase if they're American, and Huobi, and they can upload their ID and make a transaction. But decentralized exchange, as I mentioned, you should connect your wallets with the exchange. And not many people still knows how to do it, right? We will do a workshop. So at the end of the course, we'll make sure everybody has their MetaMask and knows how to make a transaction on a DEX. So what are the popular DEXs? One of them is Curve Finance, and it has the biggest TVL, which will come to its total value locked. Also, Uniswap is the second one, and probably it has a really big market, maybe bigger than Curve Finance. There are a bunch of other ones, but I just heard the top 6 here, like Curve, Uniswap, Balancer, Bancor, SushiSwap. So I never used the other ones or heard the other ones necessarily. The DEX aim to offer lower transaction fees, right? That should be the point. Hold their own assets rather than giving their assets to a user interface. So if Binance comes tomorrow and tells, hey, I am going to the Mars with Elon Musk next, the rocket, right? What will stop that guy doing that? But DEX has some issues. For instance, in case of a flow in their smart contract, they might not compensate their liquidity providers. And this is called impermanent loss. So basically, if there's a flow, somebody hacks it, you might be able to lose the addition to that liquidity pool, right? And I am not sure how they compensate you if there's an insurance plan behind it, right? So I think insurance will be really important, and I would call it InsuFi, insurance finance. So eventually, if somebody steals your money from Binance, Coinbase, or a decentralized exchange like Uniswap, you should get compensated, right? It's not your mistake, but it is their mistake writing that smart contract flawly, right? So they should figure out what the flaws in that contract before they deploy it. So if their mistake results in a loss of your funds, then there should be a solution for that. Especially if you are studying law, that's a really good area to do a research. One thing is users don't get any say in a centralized exchange, right? But in Curve Finance, Uniswap, they might issue to you guys some tokens, and with those tokens you might have a vote in the future of the DEX. In summary, the DEX offer a bunch of innovations in liquidity pools, aggregation tools, and brings a bunch of financial instruments. And now we will define what is market making, and then we'll talk about automated market makers. So the market making, just the name says, when, let's say, person A wants to sell 10 Bitcoin at a price of 40,000 and person B wants to buy 6 Bitcoin at the price of 35,000, right? So the market maker software, the one that you see it in the Binance, right? You see the buy and you see the sell price. So market maker pushes those prices and makes sure that there's a middle price that people have some agreements for that transaction. So that means B should increase their buying price and A should decrease its selling price. right? And this thing is called order book. So when you do a transaction, let's say you give an order, hey, buy at 36,500, right? So that's written to an order book, similar to the buy order. And through these order books, the market making basically makes these transactions. It has a software running behind, and it finds a common ground and makes the transaction. So, and the nice thing with these order books is it helps increasing liquidity. Basically, the more transactions happen, the more liquid is the market, right? So in decentralized finance, we don't have an order book necessarily. So what we have is automated market maker, which will come to that. So there is this term called slippage, right? So slippage refers to the purchase of or sale of an asset at an undesirable price. So basically, if there is no negotiation happening, then the transaction might result with a loss of one of the parties. And basically, if one of the parties is not happy with the transaction, that's not a good financial markets, right? So slippage is basically referring to a transaction that's happening at an undesirable price because there are not enough participants or there is not enough liquidity in that market. So when the decentralized finance came, there has been a new understanding of order book. So in the order book, there were two peers, buyer and seller. Now we can think it like peer and a contract. So you don't necessarily buy it from or sell it to somebody, but you deal with the contract. So as I mentioned, like this is a liquidity pool. Let's say Uniswap has a bunch of tokens inside. So a liquidity provider deposits 10 token A's and 1 token B. And in return, he can get 4 LP shares. And these liquidity providers, in return of them depositing these tokens, they get rewarded. So let's say Khan has 5 Ethereum, and instead of going to the regular bank, like let's say American Express or Akbank, rather instead of getting 2% interest, he puts his money to Uniswap pool, and Uniswap gives him 10% for token A, right? And 5% for token B. So, and he gets basically his shares. And that's how he makes money. He's the liquidity provider. And his intention is to get interest from the pool. And then basically trader doesn't need a buyer or seller, right? He can just make the transaction with already provided assets in the pool. And he can say just, hey, I want to get 10 token A, right? And I want to get 1 token B, vice versa, right? He can basically do that transaction. Well, the question is, how is Uniswap deciding on the token of A and B? Like basically in the normal markets, a seller would say, hey, I'm selling my token for this price. But in the pool, the software is basically looking at a bunch of different markets and arranging the price, right? So that's the benefit of the liquidity pool. Well, the problem happens mostly in other decentralized finance. Uniswap is a huge one. But if you just come with a new decentralized finance of your own, that's the problem. How will you attract these liquidity providers, right? So you should really have a good investors backing you and providing you that liquidity. Otherwise, your pool will not work. Trader will come and they won't be able to find the assets they want to get, right? Pool is empty. So I think this is, if we want to summarize what is automated market makers, it's a computer program that automates the process of providing liquidity. Basically, there is a software running at the background and providing assets to the traders and providing rewards to the liquidity providers. So as I mentioned, there's a software at background this is for Uniswap. So that is the software is basically X times Y equals K. So X is the token amount of the first asset, Y is the token amount of a second asset, let's say, and K is a constant that is determined by the Uniswap pool. And every decentralized basically exchange is using a different algorithm, and that's what makes them different. So for instance, using this algorithm, Uniswap AMM maintains a negotiation between two parties. Basically, this is the rules of that pool, and the AMM can conduct negotiations and transactions. We'll talk about more of these protocols in the DeFi module. So I am basically right now scratching the surface to make sure that that you understand there are protocols and rules behind these decentralized exchanges. Okay, like basically Uniswap is one of the big decentralized exchanges. It uses the automated market making, and the platform is one of the earliest ones built on Ethereum. So it is one of the first to market. So it has a huge investors and basically users pool inside. And one thing that about these decentralized finances, these are completely open source. For instance, Uniswap was basically on the web. So, and Bekir can go to GitHub and clone the entire source and start their own decentralized finance. That's not the hard thing, but he needs probably thousands of people to do transactions in the liquidity, right? You should need their money, right? He should ask all of our Ethereums and, hey, put your Ethereum in it. I will give you 50% back, which is not straightforward, right? He should beat the market because there are a bunch of decentralized exchanges. They are giving crazy amounts of interest back. So how can I beat like 20%, right? I should really have a big team of financial, basically savvy people who knows how to give a lot of interest back, right? So, and you can look at this later. Basically, it compares the risks and benefits of Uniswap, and it compares the fees, like basically if the fees are fixed or if the fees are variable. What about the governance fees, right? If you want to basically decide on the actual future of the Uniswap because you put a lot of liquidity in it, right? Now you are one of the stakeholders. So, and then how much should I deposit minimum to get the rewards, right? They put some minimum awards sometimes, minimum deposits required. So this is the timeline of Uniswap. So probably you saw similar pictures in crypto and blockchain markets. And the Uniswap started in 2018 with basically its automated market makers. And for instance, the trading fee was 0.3%, right? And maybe it might have dropped it, as you can see, to 0.05%. Because now the competition is tough. For stablecoin pools, now the fee is only 0.05%. But for some other pools, if you, instead of stablecoin like Tether, if you want to place some other coins into the pool, well, then it is a variable, right? And probably it's increased the range of tokens available to the users, right? And also it's brought some new functions called flash swap and flash loans. Basically a user can get and buy or lend some money or borrow some money, but I think that is more in the lending side. So, and I think this is enough for this. What are the other competitors of the Uniswap? So Curve is one of them. And probably Curve is just a copy of Uniswap, a little bit changed. As I mentioned, you can just go and copy it. But the difference between Curve and Uniswap is the amount of tokens that are in the pool and interest rates, right? So most of these competitors are doing same things, maybe with one or two function difference, but the Curve is basically, if you look at the difference of Curve and Uniswap, it is mostly stable coins. Curve came out as a new decentralized exchange with the motto of, hey, bring your stable coins and we'll give you huge interest back and with minimum fees, right? And that's a really big catch because everybody keeps their money in stable coins when there's volatility, right? Somehow Bitcoin dropped. Hey, let's switch to stable coin, Tether. And what will I do with my Tether? The Uniswap gives only like 5% to the liquidity providers, but Curve gives 15%. Then Curve suddenly grabbed in, attention, right? Everybody start to use Curve. And I compare this a lot with Getter and Trantio, right? So Getter got into the market early, but Trendyol is always trying to steal their customers, especially at the food sites. But once you have the app on your phone, it's very hard to switch. That requires a change of mindset. That's her specialty, that lady there, Betul. And how do we switch from using one product to another one? This is a really big, important focus. And there are a lot of companies, they will start to look for people in this area. And to get specialized in this area, you need to know the entire market, right? You need to have an understanding of the entire blockchain market. That's why this module is about teaching you a little bit of this and that. The total value locked is basically the overall value of the crypto assets in that pool, right? So Tolga provided his 5 Ethereum and Khan provided his 5 Maker token. And the total amount of assets in terms of Bitcoin or Ethereum, as you can see in this picture, for instance, MakerDAO had a total value locked of $16 billion. So basically, that's the pool of $16 billion that is available for lending, right? So if I go MakerDAO and tell them, hey, give me $16 billion. Would MakerDAO give that to me? It wouldn't, right? What if I take $16 billion and run to Mars with the Binance CEO together, right? I buy my seat in a rocket going to the Mars. You need to provide collateral, right? Teminat. So basically the collateral helps MakerDAO decide, well, for 16 billion, he provided me 24 billion collateral. Basically, if you don't have money, you cannot get the 16 billion. You need to have money, right? So that's why the investors have money. So if without having money, you cannot really be an investor. You should always start with some money. So he says, okay, I won't even get a 1-to-1 collateral. I will get a 1 to 1.5 collateral to minimize the risk. So anyways, if we go back to the total value locked, basically the more the liquidity pool, the more stronger it is. That's why Maker is one of the really strong lending protocols. You can stake, you can lend, and you can use the liquidity pool. And basically TVL, the total value locked, is in terms of the tokens, there are a bunch of different tokens inside the pool. So in terms of dollar value, it's not fixed, right? Because the prices of these assets changing, it's a portfolio of those assets. So that total value lock changes every single second, right? But the market cap of the token is something different. The market cap of a token may be high or low relative to the total value locked. So if you are an investor and you suddenly realize the market cap of the token is super low, but the total value locked is super high, what would you do? Total market value is the price of the token times the number of tokens in the market. So that means the company is what? It is undervalued, because if the market cap is low, that is the price. Token needs to be higher. So as an investor, you should look at bunch of different performance indicators. And I think the total value locked is one of the biggest indicator for a trustworthy market, right? So we talked about collateral a little bit, right? So you go to the Maker and you have to provide some kind of a collateral. And usually it's 140% or 130%, depends on market and depends on the protocol, but the collateral should be always higher than the loan actual itself. So there are interesting markets, I think centrifuge does. So let's say you have a house in the real world, or you have a car. So it's a real world asset, and you somehow provide that asset to the market, and you say, I don't have necessarily 10 Ethereum, but I have my house, and I am providing that as a collateral. And then that assets, probably you need to show a kind of form or document, right? Because I'm not sure how you can collateralize that asset in that world. So then eventually, after providing that collateral, the Maker, and it says here drop tokens. So you get some tokens and they are locked, and then Maker gives you back DAI. DAI is its token, right? As a giving the loan in terms of its own token called DAI, which is a stable coin. And it's backed by the Maker, and you get the DAI basically as a loan, and you do your own business, whatever it's needed for, right? And then you pay it back. But your real world asset is the collateral, basically. Why would I need a loan in this market? Why wouldn't I go to the bank and do it, rather than the government doesn't have to know that you are doing this transaction necessarily? What else? The fees, right? For a $1 million of loan, they will get again like 10,000, maybe more fees. And it's not just bank. There are a bunch of, basically, I call it parasites. They are after your money, right? But here, there is only a decentralized platform. You don't deal with any human. There are protocols that are used for years without any hack. There's a huge liquidity pool, so they are not dumb to put their huge amount of money there, right? Obviously, it's a good protocol for years. So I would rather do it with $1,000 of fee, right? Much better. Of course, there is a fee here. The another stuff is that you mentioned, I don't have to pay tax necessarily here, right? In the decentralized. And that's why the governments are not still regulating the markets, because they don't know how to tax things. So that's a huge problem. So long story short, these markets called lending markets, like the one I mentioned with makers, and the borrower provides the collateral, right? The lenders provides the tokens or whatever needed, and the borrower gets the crypto. The lender doesn't necessarily have to provide token. It can provide dollars, and the lending platform just convert it, right? So the borrower gets the crypto, and then after it's done, he's done with it, he just repays the loan with its interest, right? And gets the collateral back. Got it? So this is called what? This entire mechanism is smart contract, right? This is the rules of the protocol, right? So the rules are written, and if there's a flaw in this rule, somebody can just provide the collateral, get the loan, and then there is some flaw in the code. He doesn't pay the loan, get the collateral back, and runs away, right? Then there has been a lot of stuff like that. There is something called flash loan, which we'll learn in the next modules. It's step by step, like step 1, step 2, step 3, step 4, step 10. And if there is a flaw in one of the steps, people just can basically exploit that step and make millions of dollars. So that's why it's still dangerous dealing with platforms that are providing crazy amounts of rewards, to put liquidity, because it might not be trustworthy, right? It's a huge risk at some point. And these are the protocols, landing platforms. As you can see, Maker is the number one. Aave and Compound, which came just after Maker to the markets, is number 2 and number 3. It's basically they are little bit slight modifications of Maker at some point. So the time to market was really important because, as you can see, these are also on Ethereum, but they didn't really get to close to 16 billion, right? After here, number 5, basically it's super fragmented, but number 1, 2, 3, they are the top 3. Like these are the champions at some point. We'll see if they will catch up the other ones, because ecosystem is growing super fast. We talked about Maker a little bit, and I won't really get into so many details, but the Maker landing platform is actually a DAO, right? DAO is, as I mentioned, it's a decentralized autonomous organization. So that means the decisions or the future updates of the Maker will be decided by the investors of Maker DAO, right? If, let's say, what was your name? Let's say Alperen has thousands of Maker DAO, right? Basically, he's one of the ones who will decide of the features of the protocol, right? Like the protocol comes with a proposal. Proposals is a question, thumbs up, thumbs down, right? And let's say the rule is if 85% of the community says thumbs up, the protocol goes on, right? Let's say Maker makes a proposal, says, hey, we don't want to be on Ethereum 2, right? We have 85% votes. They don't want to be on Ethereum, that's it, right? So that's basically what becomes important is what Elon Musk is doing, right? Using social media and making other people see he's a big influencer. That's what he's doing. The entire purpose of his tweets is not making money necessarily. It's showing that I am the guy making the entire decisions on cryptocurrency. If I say dump it, you are done, right? And that he made it, right? He made it with Dutch. He made it bunch of other coins. And now everybody is looking at the Elon Musk's tweets. There are algorithms, like trading algorithms, that looks Elon Musk's Twitter. He gets the data. The second he posted something, the AI works at the background if it is an optimist or pessimist. They look at the keywords, dump, moon, Dutch, and then the AI puts that, algorithm, the findings into the entire algorithm. Basically, it becomes an input to the entire output, right? Similarly with the Binance CEO. That's called Twitter sentiments. Like sentiment analysis is basically really important and becoming more and more valuable. As I mentioned, MakerDAO is a decentralized lending application, and it supports DAI. DAI is a stable coin pegged to the USD. So what happens is basically if you want to provide collateral, right, you provide Ethereum and Maker generates DAI, that corresponds to that Ethereum, and you use DAI. And of course, because they deal with DAI, you can just place all your DAI into the Maker saving accounts, right? Liquidity pool, and you can earn variable interest from that, right? Well, Compound is another one. It just works similar to the Maker, but instead of like providing DAI, it provides C Ethereum, for instance, right? It's a different token. But logic-wise, the only difference from Maker, they kind of came with this proposal, this value proposition of governance tokens. So Maker wasn't the first one doing this governance token. Maybe they did, but Compound was the one emphasizing this governance token. So it became more of a society lending platform, like basically community lending platform compared to Maker, because it became more of a DAO compared to Maker. And that's how Compound start to grab the attention of the other users. Other than that, it's also on Ethereum, similar to the Maker, and it has the same traditional lending. Unlike traditional lending, it has the same liquidity pool that we mentioned, and there might be different functions. And I strongly recommend going here and search these things in Google and understand what these functions are. For instance, what is non-fungible liquidity? Right? So probably are you dealing with providing NFTs into the liquidity pool, right? So of course, I am not 100%, I'm not a DeFi architect, but there are a lot of terms coming out and a new player has to come with a new term. That's how they can differentiate from the market, right? They should invent something new so they can get attention. Otherwise, there are so many of these finance protocols already. So Compound has a really good tokenomics, and also basically these lending platforms should think very careful, right? Otherwise, what if their giveaways are much more than their liquidity, right? So you cannot just give 100% interest, and then you go bankrupt next year, right? So there's a lot of finance and fintech behind it, obviously. And if you are interested in this area, I have a bunch of books I can provide you. But the difference is the difference of Compounds from Maker, as I mentioned, is not function-wise, but it was more attracting the community with higher interests and also the governance. After Compounds, there was Aave, and Aave was also a fork, basically taken from Maker, as I believe. But the common things with these lending protocols, they're all dependent on Chainlink. We talked about Chainlink, right? So they need to get the price of the actual token. And that token price is only brought to the smart contract through an oracle. And we call this price oracle, right? The price data should very reliably come from different data sources, not just one data source, right? It should be a decentralized oracle coming from thousands of nodes. And then Chainlink takes those nodes, puts it into a function, and gives the right, perfect, punctual data that is trustworthy, right? Punctual means it gives it on time, right? It cannot just give it after 2 seconds or 5 seconds, right? Time is important. What if, no, it just gave the price data in 5 seconds, but in that 3 seconds, the entire token collapsed down, right? Basically that 3 seconds can change everything. So the Aave, I wrote all the details here. It's also on Ethereum, an ERC20 token. That means it's on Ethereum. And it's very similar to Compounds. Its only token is a token. And also similar to Compounds and Maker, it has 2 tokens. One of them is the governance token, Aave, and the other token is actually when somebody provides liquidity to the pool, it's the amounts, just like the bank gives dollars, they give the funds using this token. Okay, so there are a bunch of terms here comparing maker, compound, and Aave. And as you can see, there's liquidation penalty, liquidation factors, liquidation points, maximum loan to value, minimum collateralization ratio, right? We talked about this. MakerDAO wants the 1.5 times of your loan, but the other ones, they say, oh, only give us 1.33 times of your wanted loan, right, as a collateral. I won't go to the details of these ones, but when I Googled it, there are a bunch of explanations. So I strongly recommend, if you want to study, work in fintech industry, these are the same terms that are used in a loan. It's not just decentralized finance, but when you buy a house from a bank, that mortgage officer should know these terms, right? It's just same terms with centralized finance. All right, that was the lending platform part. So let's say you want to develop your own DeFi lending platform, right? Tolga came out and he said, I partnered with Alperen. His father is super rich, and I am a finance tech savvy, and we'll start our DeFinance protocol. Well, what do you need to make this DeFi stronger? Well, yeah, Alperen's father is rich, right? He has the money. You need marketing, but what is the phase? At what phase you need the marketing? What should you market first of all? Well, first you should figure out the KPIs. What should be your speed? How will you differentiate from your competitors, right? I gave you the examples of DeFi lending platforms, right? There were like a bunch of them. Like here, there are 15 of them. You should go and read the white paper of each single competitor, what they do, right? And how will you do it differently? Well, I am assuming they are super good in finance and their love is fintech. So you should go and look all these companies and see, how you can differentiate your product. So what would be that biggest differentiation? So the first question you should ask, well, which layer 1 protocol I should build this on? Unless you'll build your own layer 1, which is probably not that easy. Like, what are the layer 1 protocols we talked 2 weeks ago? Phantom is one of the good smart contract protocols, right? Solana, Avalanche, Cardano, etc. Polygon is a sidechain. You need to decide the mainnet, right? It should be super fast. So I think one of the important stuff is the borrowing speed, right? Because of that volatility in the market. If the market is volatile, then you should be able to make quick transactions, right? So especially let's think about the future. You are going with your autonomous car, and then you'll just go through the OGS through your IoT device, let's say, not a barcode, right? Then it should be super fast, right? It should be like that. Or maybe it was a bad example, but let's say you will make an instant decision about buying a $60 million house in Malibu, but you need only 1 minute to gather the funds. So you go to the maker, and then you just need to decide on the collateral, right? So basically the speed is becoming very important in finance, and I think in fintech that's a number one indicator of your platform. Well, the other ones is the fee, right? In the intermediaries, like how many steps. Well, in decentralized finance there are also steps. It's not that there are not any middlemen. Actually there are. Like, let's say you go to Uniswap and you want to change a token, right? Well, they are still taking a fee, right? Well, it's not like basically frictionless. It's not that you make an entire transaction for free. So Uniswap is also a middleman. I mean, we call it decentralized, but it's not that Tolga is giving me $10 and I'm giving him $10 back, right? There are no fees in that transaction. But I think one important factor is, can we do that? Can we do the entire sustainable, market and make it without taking minimum fees or less fees compared to other ones? It's basically mass volume. The more transactions you make, let's say somebody charges 2% for one transaction, but we charges 0.7%, but we get 3 transactions, same money, right? In this case, it is interest competition, but that's where the world will go. If somebody wants to make a $1 million of transaction, I would rather go somewhere that charges me less. Of course, it has to be trustworthy, right? So, but there are a bunch of basically the indicators you need to be looking at. We'll go through these things later. It's flash loans, rate switching, fiat gateway, investment rewards. We talked about these ones, investment rewards, the ones that you put your assets into the liquidity pool. Liquidity pool gives you back, right? When you also, again, still in the development process, these are the phases you gotta go. Well, UX UI design. If you don't design something that fancy as the new generation who is into crypto, right? They should go and open your UI and then they'll, wow, these guys are from some other world, right? They will fancy you and they will make the transaction, obviously, right? So development of the product, of course, test and launch is very important. When you provided your platform, before deploying it to the blockchain, you should have it audited from another company to make sure it has no flaws in the contract. Right? I won't go to details of this today. This is the building blocks of DeFi. There is a settlement layer, asset layers, smart contract layers, application layers. So settlement layer is basically the layer 1 protocol. As I mentioned, where will you set it up, right? Is it on Ethereum? Is it on Avalanche? What kind of consensus it's using, right? And on top of it, it's the asset layer. For instance, in the Aave case, there were 2 tokens. One of them was governance token, and the other was actually the stable coin backed by the Aave, right? Or backed by the Ethereum. So is it crypto backed or is it algorithmic stable coin that you are providing? And then on top of it, rules of the contracts, right? I showed you when he provides the collateral, then I give the loan, and then he has to provide me back the loan. I give the collateral back, right? The rules of the smart contract, as simple as that, but the more functions are added, of course, you add more lines to the contract, more complex it becomes. It's been a little bit late, so I will put it here, but you can read it. These are the layers, especially if you wanna, in the future, build a fintech company, definitely this is worth to read.